Before we get into the details, it's worth asking what boards are even supposed to do in the first place. Theoretical board roles versus 2025 reality. On paper, the responsibilities of a corporate board are straightforward. Provide oversight, set company strategy, and protect shareholder interests. These roles are supposed to create a check on management, ensuring decisions align with the long-term health of the company and its owners. But by 2025, the way boards actually operate has drifted far from these ideals. Most directors now spend minimal time on company matters outside of scheduled meetings. According to the latest Equilar Director Compensation Report, the typical S&P 500 board meets about 4 times a year, with some directors reporting less than a dozen hours of preparation and engagement between sessions. The result is a system where key decisions are often made quickly, with little scrutiny. Analysis from PwC found that 91% of directors vote in line with CEO recommendations on operational issues, signaling that true independent oversight is rare. This pattern isn't just theoretical, it has real consequences. When oversight fails, the fallout can be immediate and costly. Take the case of Kohl's in 2024. CEO Ashley Buchanan was forced out after just 4 months when the board's audit committee uncovered undisclosed conflicts of interest and questionable vendor deals. The company's own proxy statement details how the board's investigation began only after whistleblowers flagged issues, not because the directors noticed problems themselves. Christine McCormick Day, who chaired the audit committee, later admitted that the board relied too heavily on management's assurances and failed to verify key details independently. Despite these high-profile lapses, board seats remain highly sought after, not for the workload, but for the access and prestige. Appointments are often based on personal connections or signaling value rather than expertise. For example, Meta's addition of Dana White to its board was less about his background in technology and more about expanding the company's network into sports and entertainment. Similar patterns appear at Disney, where a private equity partner with no media experience landed a board seat due to long-standing ties with company leadership. Attendance records show she missed more than a third of meetings while serving on multiple boards at once, a growing trend among S&P 500 directors. Directors frequently juggle several board commitments, raising questions about their ability to provide meaningful oversight. In 2025, 22% of S&P 500 board members serve on 4 or more boards, up from 15% just 5 years ago. This overboarding trend leads to absenteeism and disengagement. The SEC recently issued findings that a significant proportion of directors at major tech firms routinely join meetings late or leave early, yet still collect full compensation and voting privileges. Increasingly, boards rely on management presentations and outside consultants rather than conducting their own due diligence. United Airlines' approval of a new scheduling system in 2024 happened without a single director interviewing frontline pilots, contributing to operational chaos that summer. Boeing's Quality Committee, facing ongoing 737 MAX issues, met just twice during the year and depended entirely on executive briefings instead of independent verification. In both cases, the board's lack of direct oversight played a role in the resulting failures. Technology was supposed to make boards more effective, but the shift to virtual meetings has often made things worse. Directors can now multitask or disengage entirely during sessions. Regulatory filings show that some independent directors at major companies log into meetings from multiple time zones, sometimes participating for only a fraction of the allotted time. Attempts to improve decision-making through AI risk tools have mostly served to justify existing biases. At ByteDance, directors overrode their own AI governance platform's warnings about a new product launch because the flagged risks didn't feel right, leading to a costly market flop. Shareholder representation has also become more symbolic than substantive. Large institutional investors, Vanguard, BlackRock, State Street, control the majority of shares at many public companies and wield outsized influence over board appointments. This concentration of power means that boards often serve the interests of these institutions rather than the broader base of shareholders. Harvard's corporate governance research shows that boards approve CEO pay packages significantly higher at companies where directors have little personal investment in the business. Carnival Cruises, for instance, paid its directors nearly $500,000 each while they owned almost no company stock, yet still approved a multi-million-dollar bonus for the CEO during a period of sustained losses. Conflicts of interest are common. Nearly 40% of S&P 500 boards include at least one member whose outside business receives payments from the company. At J.P. Morgan, the lead independent directors consulting firm has received millions in annual fees, while at Goldman Sachs, the audit chair's law firm handles lucrative legal work for the bank. These overlapping relationships undermine the independence that boards are meant to demonstrate. Efforts to improve diversity and accountability have produced mixed results. The 2025 Equilar Gender Diversity Index shows women now hold 29% of board seats, but only 8% of chair positions. Broader diversity measures, covering cultural background, disability, LGBTQ+ status, and more, are tracked, yet companies sometimes appoint paper directors to meet regulatory mandates with little expectation of meaningful participation. When the SEC required climate expertise on boards, several firms added token environmental specialists who rarely attended meetings. In proxy fights, institutional investors overwhelmingly back incumbent boards, even at underperforming companies. ISS Analytics reports that in 94% of contested elections in 2024, the big funds sided with existing directors rather than activist challengers. This insularity keeps the system stable for insiders, regardless of company results. While boards technically have the authority to remove CEOs, they rarely act unless forced by scandal or external pressure. In 2024, just a dozen Fortune 500 CEOs were ousted by their boards, nearly all following criminal charges or activist campaigns. At major tech firms, independent directors now routinely outlast the CEOs they oversee. The gap between the theoretical role of boards and their day-to-day reality is wide and growing. Yet the rewards for board service remain substantial, even as accountability slips further from view. 2025 board compensation structures. Director pay in 2025 reflects a system carefully engineered for maximum reward with minimal exposure. Board compensation at S&P 500 companies now averages $242,000 per year, according to the latest NACD and Pearl-Meyer report, with the median total package holding steady at $325,000. These figures have risen only modestly in the past year, but for directors serving at the largest tech firms, the numbers climb much higher. At Meta, for example, directors received between $397,000 and $4.2 million last year, combining equity grants, annual retainers, and travel reimbursements. The most sought-after seats go to those already sitting on multiple boards, multiplying the financial benefit with each additional appointment. Compensation structures are highly standardized. About 60% of the typical package comes in the form of equity, usually full-value stock awards that vest immediately or within a year, while the remainder is paid as a cash retainer. The standard annual cash retainer for S&P 500 directors hovers around $130,000, and committee chairs receive an additional $20,000 to $50,000 for their added responsibilities. Most companies have eliminated per-meeting fees, opting instead for these fixed annual retainers. Committee service pays extra only for those in leadership roles, reflecting the expectation that routine committee work is part of the base job. Industry differences in pay remain stark. Directors in the energy sector routinely earn nearly 50% more than their counterparts in healthcare, despite weaker shareholder returns. For instance, Exxon's board approved $350,000 packages for themselves in a quarter when the company lost $12 billion in value. Meanwhile, boards in pharmaceuticals reduced compensation slightly after high-profile drug pricing scandals, yet median pay still reached $290,000. These disparities highlight how board pay is often insulated from company performance. Severance arrangements for departing directors have also grown more generous. When Credit Suisse collapsed, outgoing board members received $4.7 million in accelerated equity despite overseeing catastrophic losses. Boeing's directors secured $2.4 million in retention payouts just before another 737 MAX grounding. These golden parachutes persist because boards set their own severance terms, and nearly all S&P 500 companies now have automatic vesting triggers for director equity upon termination, regardless of circumstances. The disconnect between director pay and company outcomes is difficult to ignore. Tesla's board collectively earned $38 million last year, while facing repeated SEC violations. At Wells Fargo, directors approved $275,000 packages shortly before the company was fined $1 billion for regulatory failures. Research consistently shows that companies paying directors above the market median tend to underperform peers by several percentage points on shareholder returns. Shareholders and activists have begun to push back. The California Public Employees Retirement System, for example, voted against nearly half of director compensation plans last year, a sharp increase from just a few years ago. At Disney, activists forced the board to abandon automatic equity grants after it was revealed that directors had approved a $65 million package for the CEO during a period of mass layoffs. Still, efforts to tie pay to performance often meet resistance. When State Street pressed oil companies to link director compensation to climate goals, boards simply reclassified emissions targets as non-core metrics, sidestepping meaningful reform. The gap between director and employee pay continues to widen. Median board compensation now equals 23 times the average worker's salary at S&P 500 companies, up from 18 times just 5 years ago. At Amazon, the ratio reaches 68-1, driven by large stock grants. Interestingly, firms with narrower gaps, such as Costco and Salesforce, tend to outperform their peers both in profitability and governance scores. Conflicts of interest are frequently embedded in these pay structures. J.P. Morgan's lead independent director received $6 million in consulting fees from the bank while participating in decisions about executive compensation. Pfizer's audit chair divides his time among multiple boards where his law firm provides services. The proportion of S&P 500 directors with significant financial ties outside their board fees has risen to 63%, up from 41% 5 years ago, raising questions about independence. Defenders of current pay practices argue that high compensation is necessary to attract qualified candidates, but the evidence is thin. High-profile appointments, such as Apple's addition of a crypto founder with no governance experience, who received $485,000 in restricted stock, suggest that prestige or connections often outweigh expertise. Former Fortune 500 CEOs, when added to boards, routinely command 40% higher pay. Yet studies show they do not consistently improve governance outcomes. The mechanics of director pay are largely self-reinforcing. Board members frequently serve on each other's compensation committees across companies, creating a network where approval of generous pay packages is the norm. For example, the CEO of one company may sit on the compensation committee of another, and vice versa, ensuring that nearly all director pay proposals pass with little resistance from shareholders. New disclosure requirements were intended to increase transparency, but have sometimes had the opposite effect. As more details about pay components became public, boards shifted compensation into less transparent stock awards. Meta, for instance, now pays directors entirely in restricted stock units that can be cashed out immediately, while some banks introduced performance shares with loose or easily met criteria. Both strategies allowed director pay to rise, even as company performance lagged. Director compensation is closely tied to company size rather than performance. Large firms like Walmart pay directors $260,000 annually despite ongoing operational problems, while smaller, better-run companies like Costco offer lower board pay but deliver stronger results. This size-based formula can create incentives for boards to pursue mergers or acquisitions that increase their own compensation bracket, regardless of whether those moves benefit shareholders. While institutional investors such as BlackRock and Vanguard have started voting against excessive pay at some companies, meaningful change remains slow. The average board tenure has actually increased in recent years, suggesting that the system remains resistant to outside pressure. The current compensation model not only rewards board members handsomely, but also encourages the formation of tight networks among directors. These overlapping relationships set the stage for a deeper look at how board interlocks shape corporate power and influence decision-making at the highest levels. Interlocking Directorates in 2025. In 2025, interlocking directorates, where individuals serve on multiple corporate boards, often across competing firms, remain a defining feature of corporate governance despite mounting regulatory attention. These overlapping board memberships create a tightly woven web of influence, where decision-making authority is concentrated among a relatively small group of individuals. Recent data shows that 37% of Fortune 500 boards share at least one director with a competitor, even though Section 8 of the Clayton Act prohibits such arrangements when they threaten competition. Patterns emerge quickly in these networks. For instance, the CEO of Verizon sits on IBM's board alongside a former BlackRock CFO, who also serves on Exxon's board with a Disney director. That same Disney executive helps oversee Apple, creating a chain where the same handful of people shape strategy across multiple industries. While the number of directors serving on 3 or more Fortune 500 boards has declined from 212 in 2020 to 147 today, the remaining network is still dense enough to influence major sectors. This contraction is largely due to stepped-up regulatory scrutiny, but the core issue persists. Conflicts of interest are common in these arrangements. When Pfizer and Moderna shared a board member in 2023, that director participated in pricing discussions at both companies, which soon announced nearly identical vaccine prices. The FTC intervened, resulting in a forced resignation, but similar cases continue to surface. A Boeing director who also served on Spirit AeroSystems approved contracts for both companies, despite clear supply chain conflicts. Only after a widely publicized safety incident did this relationship come under scrutiny. Regulatory agencies have tried to tighten enforcement. The FTC updated its Section 8 thresholds for 2025, prohibiting interlocks when companies share more than $51.38 million in competitive business. Yet, companies often exploit gray areas, such as appointing non-voting observers or consulting directors, to maintain influence without triggering explicit violations. Lockheed Martin and Raytheon, for example, share a consulting director who attends all board meetings, but technically lacks a vote. The Department of Justice argues that these roles still breach the spirit of antitrust law, but enforcement actions remain limited, with only a handful of cases pursued this year. A new requirement for HSR filings, effective February 2025, mandates disclosure of director overlaps for entities with competitive ties. Early reviews suggest that compliance is inconsistent. 14% of Fortune 100 companies failed to report interlocking relationships in their initial submissions. Even when violations are identified, penalties tend to be minor. Wells Fargo, for instance, paid a $250,000 fine after failing to disclose a director's dual service on its board and that of a fintech competitor. The consequences for competition are significant. When directors sit on the boards of rival companies, pricing and innovation often stagnate. For major airlines share 3 directors, and their coordinated baggage fee increases became public after these interlocks were mapped. Telecom firms with shared directors implemented similar 5G pricing structures within weeks of each other. In the banking sector, boards with overlapping directors approved nearly identical overdraft policies, despite vocal public criticism. Some interlocks verge on the absurd. Elon Musk's brother Kimball sits on Tesla's board and, until recently, also served at Chipotle, which had board ties to Panera's CEO, creating a fast-casual governance triangle. More concerning is the role of large asset managers like BlackRock and Vanguard. Their employees often sit on the boards of multiple competing companies, consolidating influence in sectors ranging from consumer goods to energy. Institutional investors are starting to challenge the practice. CalPERS voted against 43 interlocked directors last year, and Norway's sovereign wealth fund blacklisted 17 companies over board overlaps. Still, resistance is uneven. When State Street opposed Coca-Cola's interlocked directors, the company successfully argued that industry experience outweighed antitrust concerns. In pharmaceuticals, 62% of known board interlocks remain, even with clear competition issues. The effect on board culture is measurable. Surveys indicate that interlocked boards experience less dissent. 89% of votes are unanimous, compared to 76% at non-interlocked firms. This trend toward rubber-stamp decision-making contributed to high-profile failures like the Credit Suisse collapse, where directors missed warning signs while serving on multiple crisis-prone boards. Financial incentives reinforce the system. Directors with multiple board appointments earn an average of $487,000 annually, compared to $225,000 for those serving on a single board. The highest earners, such as a former Pfizer executive now sitting on 4 healthcare boards, collect over $1.2 million per year. These rewards encourage directors to maintain the network, even when it undermines independence. Companies often justify interlocks by claiming they bring valuable expertise, but studies show that boards with high connectivity underperform on innovation. Recusal policies are frequently cited as safeguards, yet 78% of interlocked directors admit to participating in discussions before abstaining from final votes. At GM, an Amazon board member joined lengthy talks about electric vehicle strategy before formally recusing himself from the vote. Legal and consulting roles add another layer. McKinsey's former head sits on both Delta and United's boards while the firm receives millions in consulting fees from both airlines. Private equity partners often serve on the boards of competing retailers that pay their firms for advisory services. Since 2020, these arrangements have increased by 42%, replacing true independence with transactional relationships. Regulators are beginning to address informal interlocks more aggressively. The FTC now warns that even consulting and observer roles may violate antitrust laws if they allow access to sensitive information. Recent enforcement actions have targeted tech companies where executives held advisory positions with competitors, but overall, only a small fraction of known interlocks have faced regulatory action this year. Proponents of interlocks argue that they provide stability, noting slightly lower bankruptcy rates among interconnected firms. However, this stability comes at the expense of innovation. Patent filings drop by nearly 20% at companies with interlocked boards. The arrangement tends to entrench incumbents, especially in older industries like energy and automotive, where interlock rates are highest. Shareholder proposals to ban interlocks are gaining support, with 14% passing last year, up from 3% in 2020. But the underlying incentive structure remains unchanged. Board compensation still rewards directors for holding multiple seats, regardless of performance. Without a shift in how board service is valued and compensated, interlocking directorates are likely to persist, shaping decisions at the highest levels. These relationships also affect how much time directors dedicate to each company, raising questions about what time commitment and meeting structures.